presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and welcome to the Compact Market Wrap Weekly Update for May the 4th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President at Compact Asset Management. We're going to talk about the markets, what happened last week, what to expect this week. First of all, a quick note, click on the subscribe button so whenever we post an update, you'll be notified and you can watch it at your convenience. Also, you can go to compact.com, click on Insights, and all the episodes are there. If you need help with your portfolio, give us a call. And I think now is the time to do it. We're close to all-time highs. We were at Friday. We backed off today. But I think it's time to take a good, hard look at your portfolio right now. Give us a call at 800-388-9700 or just send us an email at invest@compact.com. Javaid, let's start with the numbers. Good week last week. Came back up, new all-time highs for the markets. We saw the S&P up 0.85% or 0.92, 0.55 for the Dow. We saw 0.94 for the Russell. And we also saw the NASDAQ up 1.12%.
Yeah, so across the board, markets continue to make new highs last week, which is really encouraging to see. S&P is up 6% year to date. Small cap up 13%. Growth hasn't been great, but has actually been the best thing that's recovered here over the last 1 month. Growth is only up 1.64, whereas value is up 10, but growth really has been the story recently. And so, it's still very much, I'd say, a bull market is alive and well. Animal spirits are there. The earnings have been really good, both in terms of earnings and revenues. So that, I think the biggest surprise is that the earnings revisions continue to go higher, much higher going forward. So now analysts are starting to look at not even the second half of 2026, but also what the earnings might be in 2027. And those earnings look really robust. And so when you look at the forward PEs, so that's looking at the current valuation of the stock market, even though we're at all-time highs, we're 6% higher than we were at the end of last year, the forward PEs have actually gotten cheaper. Now, it's all anticipation.
It's all dependent on if those earnings are going to materialize or
Correct.
not. That's really going to be the key. And, everybody can hope. I hope the earnings are wonderful. We've got great earnings this week. Mm-hmm. But I think the Straits of Hormuz situation is starting to really, I think is going to sooner or later have a problem. Unless we open the strait. If we open the Strait of Hormuz, oil starts to flow, we go to new highs and way beyond. Mm-hmm. Then I think we can justify everything that is expected. But sooner or later, gasoline at $6 a gallon here in California, $4.50 a gallon for the rest of the country, and prices, I was looking at Europe, they're $9, $10 a gallon. Mm-hmm. I mean, it is just crazy prices for energy, and that sort of percolates throughout the economy. It's just not gasoline, it's jet fuel, it's diesel, it's all the plastics, it's all the fertilizer, it's all the things. Mm-hmm. And today we saw an escalation in the Gulf again. And where are we going to go? I think at this point, this is my opinion, that we are sort of stuck in a no-win situation. That's where we are. And the Iranians know they have the upper hand unless we decide that we want to go in and finish this. And that will be a tremendous escalation that the president decides, you know what, politically, I know I paid a price already. I've got nothing to lose anymore. Now we're just going to go out, take out Iran, take out their infrastructure, take out their oil structure, just take out everything out of Iran. Mm-hmm. And yeah, that'll cause damage to the oil fields. Iran is going to retaliate, so there'll be damage to some of the oil fields in the UAE, in Qatar, in Oman, where a lot of the gas fields, and could be Saudi Arabia also. But that is already shut down. There's no oil coming out of those places anyways.
Yeah.
So at this point, either we finish this, or if this lingers, we've got a problem. That's really where we have it.
Well, when I look at the Strait of Hormuz, I definitely feel like the leverage is with the Iranians, and they're not going to give up that leverage very easily. And even I think there's other players involved too. I've always talked about Russia and China as well. I think Russia's benefiting tremendously from these higher oil prices. So it's really incentivizing them. I think you're going to see, potentially wanting to keep this conflict going for a period of time. And so I think that's, as we talked about as ad nauseum since it started, looking at oil markets. But I think my question, so let's just say I do feel like the Strait of Hormuz is not opening, maybe not opening indefinitely. Let's just put it there for a second. I know that's a big claim. But and oil prices are starting to rise, interest rates are starting to rise. We need to unpack that a little bit more. But why is not, we're not seeing any sort of recessionary indicators from high yield, stock markets at all-time highs? Why isn't the market pricing in any of this potential, what seems to be a very, very big disrupting, global energy shock type of event? And we showed a chart a while ago, right, where it's a geopolitical event. The market tends to snap back up and it's no big problem. And it seems like the market's looking at it more like a geopolitical event than an actual energy crisis.
I think really the market is hoping that it's a geopolitical event, that it's a short-term war, it's going to be over and it's done with.
Mm-hmm.
And, I don't think at this point, either we just say, hey, we're done with Iran, you can have the bomb, you can control the Strait of Hormuz.
So complete capitulation.
That's, unless we go that way, the Iranians are not giving up. That's really the bottom line.
Yeah.
Unless we go and take out their infrastructure, take out the oil facilities, take out the Carg Island, that they cannot export oil for the next 10 years, 15 years.
Mm-hmm.
Totally decimate Iran, which our military can do. There's no doubt about that we can do that.
Mm-hmm.
But the price to pay for that will be damage to the rest of the oil facilities in the Gulf, to some of and more political pressure for the president, because then the war continues and everybody that politically says, well, you've got to go to Congress and declare war and all of that political price, and then we've got the November elections. But the president has a short window. If he can go in like he did in Venezuela, take out Maduro, declare victory, and it's over. We go in next couple of 3-4 weeks it'll take to really bring Iran to capitulation. But that is what the options are. Or we continue this forever.
I'm in the forever camp. I mean, I've said this. We've been having a lot of heated, kind of not heated, but animated discussions in the investment committee about, okay, and one of the opinions I think is the complete capitulation of the United States, just saying, hey, oh, sorry, we're done with it, we're out. You do what you want. And so what did we accomplish? I don't know. We didn't accomplish anything besides, showing Iran that they can actually at any given time take control of the global economy, right? And that was always a question, and why previous administrations did it. So yet the market with the earnings and everything else continues to chug along. So I think to your point, how you started the update this week, I think it's a very precarious time. The market seems to be looking past this event because it's focusing on the good that is the economy and earnings and everything else. But particularly as the interest rates start to rise, right? That's my big concern, is that the market, those earnings, even if they come, they're already discounted by that higher interest rate. And one of the key things I've been watching, and I haven't seen it in a while, and this is why I mentioned it last week on the update, is that when I look at the break-even inflation rate on the 10-year time horizon, really long-term time horizon,
Right.
that has started to move up. Short-term inflation expectations have actually come down, but long-term inflation expectations have started to move up. And that just starts to tell me maybe the market, the bond vigilantes, are starting to kind of sharpen their knives a little bit. And I think that I don't think it's the end, it causes maybe a recession. I think it can definitely cause a correction in the stock market. But those things are starting to percolate. And as we start to see more and more pressure, the 10-year hit 4.4 today. Whenever we get above 4.4 on the 10-year, I start to say, we're kind of in this red zone area. And who knows, if the rates go back to 5% on the 10-year, then the market, regardless of what the earnings expectations are, it's overvalued.
We have to reprice everything. And
Yeah.
the market will have to reprice everything because that is a function of what the interest rate is and what is the expected rate of return on the market. So you have to reprice everything, and that repricing could be a lot different than where we are today. So that's why I'm concerned. I hope that this whole thing just goes away now, but that's hope, and hope is not a good investment strategy. You have to have concrete decisions that you make, that this is how much pain you can sustain in your portfolio, this is how much you can give up, this is how much you've gained, and it's not what you make. You've heard me say this for 30 years on the radio show, and now I'm saying it again. It's not what you make, it's what you keep that counts in the long term. And that's where we are. Communication services was the best sector last week.
Yeah, communication was up big. Energy now also getting a nice rebound recently. Hasn't been doing great, but as oil prices have gone higher, energy has definitely moved higher. Materials were the big loser last week. But you still look at year to date, energy up 32%, materials, industrials, real estate. You know, what I like about this kind of sector allocation is also that you're having a variety of sectors are up. Right, it's not just tech, right?
Yeah.
Technology is up 8.2, S&P is up 6, but you have a lot of kind of broadening. We've seen it broaden out among mid-cap and small-cap stocks are off. So everything kind of still looks really good. You know, the fundamentals are there from an earnings perspective, yet maybe we're getting a little bit too far ahead of ourselves, you know, with particularly if interest rates continue to rise. And we'll talk about the 10-year chart and what you should be thinking about when you talk about, well, how do you keep what you've made, right?
Yes.
And how do you begin to look at that? How do you look at concepts like asset location? And I'll jump right into it. The key answer is you sell some of the stocks in your 401k or your IRAs. Don't sell your unrealized gains. You should hopefully have big gains in your non-qualified accounts. And now's a good time to start to buy some bonds. Now, I talked about interest rates going higher,
Right.
but we don't know if they're going to go higher or not. But why I like bonds at this particular juncture is you're getting insurance on the stock market and your real estate portfolio, and you're getting paid 5%.
You're getting a nice juicy return.
Usually when you buy insurance, you hope you never have to cash it in,
Right.
and you have to pay for it. It's kind of a lose-lose when you're looking at insurance because you hope you're not having to make a claim, and you got to pay for it every month, every quarter, every year. With bonds, particularly where they are today, you're getting that safety, you're locking in some return, and you're going to make 5-6%, particularly if, you know, this market feels a little bit similarly to me as 2000, 2001, 2002.
A lot of hope.
A lot of hope. There's all this, you know, this hype, right? Y2K, now it's AI. It feels very similar. And but we didn't have a big recession in 2001 and 2, but you had a big correction in a lot of the growth stocks, et cetera. So now, you know, it's one of those times where, you know, you can maybe look at even high yield bonds. They can hold up very well if we don't go into a deep recession, which I don't see as anticipating. Yet the stock market, I think, is going to be very, very bumpy. And if you're very over-allocated, over-concentrated, you have to be ready to ride out that volatility.
That's really, put it in a nutshell. Javaid has put it there. You have to be able to ride out the volatility. It is going to get really bumpy, folks. That's what I'm trying to tell you. Right now, oil hit 105 last Friday. It hit new highs for 2026 today. We're starting to break out in oil. We're bumping at the high end in the bond market. We're at all-time highs in the stock market. All the good news is already out there. The earnings are out there. Everything is wonderful. Now, what's going to bring it higher next? That's the question. But oil continues to go up. Interest rates also pushing 4.39 on Friday. That's where we went from 4.31. And today we're at 4.43.
Yep,
Going on
4.44.
4.44. So I'll show you the chart. And it breaks out, bonds break out about 4.5 and head towards 5%.
Yeah, your 5-10% correction automatic.
That's what you have to be. That's just automatic. But there's still a lot of spending going on.
Yeah, so this is the CapEx chart. So once again, if you're listening to us on the podcast, you can also listen to this edition on YouTube. Just go to compact.com/YouTube. You can see the chart. But AI CapEx has been going up, and CapEx is really important. So when you think about earnings, a big thing that drives earnings is corporate investment. You know, these corporations, when they're building data centers, you know, once you kind of put the shovel in the ground and you start to order all the electrical equipment and air conditioning and all the construction equipment, this is a 3, 4, 5 year project, right? So then that can continue to give momentum to the economy for a period of time. And we've really been on this CapEx spend, really started kind of, I would say, middle of 2024. Is really when you can start to see, when things really started to accelerate. So we're seeing all the benefits of that corporate investment now in the earnings, in the economy, but how much can we keep spending? I mean, how much can we keep going?
And then again, you've got to get a return on that investment. You just don't spend money.
Well, you don't have to get a return.
Well,
You want a return.
you want a return, obviously. Otherwise, you spend. I mean, look at what was the Meta World or whatever that was.
Well, and I think we're starting to see some winners and losers around who's going to be the big, and just looking at the earnings so far this last week. So far the big winners have been all of the semiconductor companies, right? Because they're the ones that are getting all this CapEx. But then you look like a company like Meta, it's kind of in between because Meta doesn't have the cloud services. All of this AI is going to happen in the cloud, and that's really, primarily driven by Amazon and Google are the two big cloud providers. Microsoft too, Azure, but not as much. Microsoft's kind of cut in the middle, and of course Microsoft is a software company, so people are worried about AI cannibalizing software. But I really feel like Meta, Tesla. I don't know what Tesla is a Mag 7 company, but I've been very bearish on Tesla for a long period of time. I have a lot of retail clients that I'm talking to now that they made a lot of money on Tesla. They bought Tesla 5, 6, 7 years ago. I'm telling them now's a good time to collar that stock. You don't sell it, but just lock in your gains because I just don't know exactly. Yes, SpaceX and all of AI, but that's a separate company. That's not Tesla.
It's going to go public in the next 6 months or so.
Yeah, and I think also the key thing is we haven't seen where Anthropic or OpenAI, when they go public, but those are going to be some of the big new Mag 7s, right, in terms of the AI trade. But what we're really going to see is the market, this is the biggest, smartest people who have invested in AI. They didn't invest in AI this year, last year, the year before. They invested in AI 8 years ago. 9 years ago, before people could even spell AI. And that's when they actually got in. Now they're getting out. And so you have to really take that into account. There's a reason why they're getting out versus getting in. You make the money getting in when no one has a clue what it is. Once everyone knows what it is and what you say, it's obvious, potentially the hype it's not going to live up to all of the hype. And so that's why we're just beginning. We're not saying you need to make some big moves. Even here at Compact, we're not making big moves. We're not doing anything. But one of the things that we're starting to look at is the bond market looks attractive. Make sure, particularly in your retirement accounts, where you can make some changes and it's not going to cost you any sort of taxes. If you've seen your equity portion go really high, now is a good time to start to systematically rebalance so you're protected going forward.
What Javaid means is if you had a 60-40 portfolio, 60% stocks, 40% bonds, over the last 2 or 3 years, that 60-40 is 75-25.
Well, if you're lucky, if you invested all in tech stocks, it's probably 70-30.
70-30. It's gone. Your stocks have gone up a lot more. So you need to sell 10% or more, depending on wherever you are, and buy more bonds. I know it's hard. When something is winning, you say, "Oh, why am I selling a winning stock? It's going to go to the moon and beyond." They're telling me all of this stuff. Don't sell it. And if Javaid also mentioned in your taxable accounts, you need to collar it. If you don't need to know how to collar a stock, give Javaid a call. He'll be more than happy to help and show you what collaring a stock means. How do you protect yourself and protect your profits? Looking at the FOMC interest rates unchanged, we are in the Warshonomics now, where Warsh is going to become the chair. Powell said he's going to stay there.
Well, I think that I was looking at one of my reports from First Trust. Brian Westbury, he's the chief economist over at First Trust. I like their commentary. They've been a little too pessimistic for a long period of time,
right?
But maybe eventually they'll be right. But they were just talking about Warsh as the chairman in name only. You're saying because Jerome Powell is going to be sitting on the board. When you look at the composition of the board, you're only going to have basically kind of 3 kind of Trump appointees. You have 4 kind of more kind of, Powell have been under Powell's administration. So it's going to be really tough for Warsh to make any sort of seismic changes at the Fed. And some of those changes are pretty big. He's talked about getting out of long-term securities. So we're talking 10-year treasuries and mortgages and getting more just into short-term funding. Well, that can put a lot of upward pressure on the 10-year rate.
Right.
And I think the market with this inflation, and then we're starting to see the 10-year creep up, is starting to say, okay, if you want to do that, great, but we're going to test you. We're gonna jack up interest rates and see if you're really going to stick to the plan. Because usually when the market starts to get some retribution, the politicians come running and say, hey, thank you, or the Fed particularly says, no, 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 we're going to put some more liquidity back in the system, we'll print some money, et cetera. So he's talking a big game of changing a lot of things, and it's a very precarious time, I think, to make some big changes with the market where it is today. So I think that's something to really we got to watch how that evolves here. And then particularly Jerome Powell, I think he doesn't want to give Trump another potential Fed nomination on the Fed board, really wants to maintain those independence. So you're going to see a lot of clashing, I think, within the Fed, which is from a business perspective, from an investment committee perspective, is a good thing. That's what we do here at Compaq all the time. But at the same time, when it comes with the Fed and the politics, and particularly the political environment today, the more we start to politicalize the Fed, the more dangerous it becomes. The more a little bit like banana republics.
Where the president appoints
you see
their
it in
nephew
Turkey.
as the head of the chair of the central bank and tells them, lower
Do whatever
interest
I
rate.
want. Do whatever I say. Yeah.
And that's where the central bank loses credibility, the bond market, which is much, much bigger than the stock market, can really dictate where interest rates go. And believe me, the politicians don't want the bond market to take charge.
And we look at this economic data from last week. The Fed kept rates positive, but PCE was up 3.5%. I mean, we are seeing more and more inflation, and that's why I think the biggest impact right now is definitely going to be politically. If the election was today, I think Democrats would do very well. In the House, Senate's going to be tough, I think, ultimately for them to capture. But then, then we're also going to have this split government, and like I said, I think the market actually likes that, to put a little bit of curtailment on what's going on.
This week we don't have a lot of data coming out. I mean, unemployment data comes out. That's going to be
and job market looks good. I mean, most likely unemployment's going to tick down to 4.2%. So job market looks good. I know there's the AI job apocalypse. That's not happening. In fact, software jobs are actually going up. So everything economically still looks really good. It's just this is the time when when everything looks really good, everything's been priced in, those are the times when you want to be just maybe saying thank you very much, take some risk off the table, rebalance, because once things turn bad, the market's already down, and so you've missed the opportunity.
Folks, you've been on a run, you're in Las Vegas, you've had a great run, you're getting all these great cars. All of a sudden, you've got a pile of chips sitting in front of you. The question is, are you going to stay there? If you do, you're going to give them all back. I can assure you of that. Or are you going to put a whole bunch of those in your pocket and go walk around for a little bit?
Hmm?
That's the question you need to. I know it's really, really hard to do that. But right now is the time to make sure you have the correct balances in your portfolio. And that's what we're seeing. You've heard me say this. When everybody gets very happy, I get worried. When everybody's worried, I'm okay, because I know the market is coming back to some great valuations. That's the way I look at it. And that's the way right now. Everybody's happy. Earnings are great. Yeah, what about? Who cares about a war? Who cares about $120 oil? Who cares about inflation? All of a sudden, one day the market wakes up. Oh, oil is 120. We're worried. Oh my God, this. And then all of a sudden, everybody runs to the hills.
And it happens quickly.
It happens very quickly. In today's day and age, it used to happen a lot slower, but with technology, it happens in a flash now. That's what we're seeing. And look at these markets. We're at all-time highs. We broke out. We had the target on the weeklies. You got to really look at weeklies now.
Yeah.
We are right at the fifth wave Fibonacci target.
Hit it on Friday.
We hit it on Friday, and today we backed off from it a little bit.
Mm-hmm.
So this is the fifth wave. On the weeklies, not the dailies.
Yeah.
On the weeklies. And that's when you get weeklies. This weekly started right here. This was in 2020, 2023?
Yeah, and the October of 2022. That was the low.
And that's where it started. From there, it's been going.
Yeah, it's been gangbusters.
It's been we had wave 3.
Yeah, we had
4.
a tariff tantrum.
We had the tariff tantrum right here. April of 2025, and then we came right off of that. Saw a fourth wave pullback. Now it's a fifth wave. So, if we break out above 7,300, yeah, the war could end. Everything is wonderful. The Gulf Strait of Hormuz
You
is
get
open.
an extension of the fifth.
And we get an extension of the fifth. We go a lot higher. That would be wonderful. Oil comes down to $70 a barrel. Everybody lives happily ever after. Here's the NASDAQ dailies, fifth wave high. But guess what it is on the weeklies? Right in the target.
But it's going to take, just going back to your dot plot, the dot plots are way down there.
Yeah,
In terms of eventually, you could basically, it's the lows we were at back in March. You got to basically get all the way back down to
but
21,000.
the stock plot is going to come up.
Yeah,
It's
slowly.
It's slowly over weeks, 3 or 4 weeks.
Probably 2,300.
Tw-
Yeah.
23,000.
23,000, yeah.
Probably somewhere between 22 and 23. We're at 25 today. That's where we closed at 25,067 today. So 1,500 points for the NASDAQ.
Yeah.
That's what I would be looking at. It's not going to happen in 1 week. But if this is only where we go up for 4 or 5 weeks, that's not a good sign. That I would get. Then I'm worried about a much deeper pullback in the market. Small caps had a great run, hit a new all-time high, hit a nice high, new fifth wave, but also fifth wave
Okay.
on the weekly small
I'm,
cap chart.
I'm sensing a theme here.
Yeah, you see. Now weekly is on the third on the
International.
Doesn't look bad. I thought we'd get a fourth wave pullback, and we're getting
And
that.
I think, but still, if we're at fifth wave highs in the U.S. stock market, international is not going up.
That's the.
if
This
things are-
could change to 3, and this could become the fourth wave.
And then the little marginal high.
High. Just a fifth wave failure is what it's called,
Yeah.
basically. What it would be. Oil had a big update today of 4.62.
I'm just so surprised. Like I said, I can, I'm starting to sense where you're at. But for me, if you would have said back in middle of March that we're going to be at 23 on DBO, all-time oil prices, and the market was going to be at all-time highs, I would have not taken that bet. I would have said there's just no way. But that's just been the power of the earnings, over this period of time, but also maybe that complacency. I don't know. We'll find out.
Well, DBO broke out above this high that we made in 22.
Exactly.
That
Yeah.
was the beginning of the Ukraine
And that's
war.
what I was watching. It was
And-
all that 21,
Yeah,
right
we-
around 21,
Yeah,
21.50.
Yep.
And we
that's what-
broke right through it
You were
last
looking
week.
for it to come back, break this on
19.
the downside, 19. But no. We're breaking to new highs.
Yet, yeah.
That's not good the way I'm looking at it right now.
Yeah.
Another vigilante, look, a big bond market move today, nearly 7 basis points on the upside, 4 points.
It's not a big move, but in bond world, that's
In bond world, it's a huge move,
Yeah,
folks.
so-
I'm not-
7 basis,
se-
7
ba-
basis points is 0.07, by the way. So not even, not even a tenth of a percent.
But 4.446 is where we closed today. And these are the highs right here.
Yeah.
Right here. Right
4.5, and then you have that ultimate high back at around 4.6 that we saw back. So that was back. That was a really seminal time for me. Was in the middle of May 2025. It was this 4.6. I don't know if people remember this, but this is the day that the House passed the OBBBA, the version of the tax cuts bill.
Right.
And they passed that bill, and interest rates reversed. They went higher, reversed lower, and since then went from 4.6 all the way down to October, went down to 4%. So it was a great time to buy some bonds. Yeah, you could have bought some stocks too. Clearly, stocks have gone up, since that time as well. You could have bought anything. When interest rates are going down for the right reason, you can buy anything. Stocks, bonds, whatever. It's all going to be good. But the fact that we're now going back to that level is still just a little bit concerning. But this is where I think, once again, it's a good time to be slowly elongating your duration. So if you have cash, think about buying some bonds. Don't go after 30 years, but maybe put them in bonds that are going out 3, 4, 5, 6 years instead of having your cash be completely. It's the shortest duration bond you can have is cash. It's only 1 day. It's completely liquid. But now's a good time to slowly but surely begin to add to that bond portfolio. Who knows? Rates could go higher and you'd be like, oh, I didn't time it perfectly, but no one can. But it seems like now you're getting paid a really nice rate of interest to have some nice insurance on your portfolio.
This is 4.5, folks. That's what I'm looking at right here. And then this is 4.65.
Yeah.
We get above this, it could be a problem for the stock market. So I would watch this and give this an indication of what happens next.
But this is telling us this is an opportunity.
Yeah,
It's an opportunity to
in
buy
the
some
bond
bonds.
market. Yeah, it's an opportunity. But is it an opportunity to chase the stock market? No, I wouldn't be chasing right now
Yeah.
because that could be a problem. Gold is also breaking down. We talked about this making a high, and I said, we could get a fifth wave, but we've used so much energy around here that I don't think we're going to new highs. And today, we're breaking again on the downside, coming close to the 3,000 mark instead of the 4,000.
Well, I think gold is also somewhat. It's always hard with gold. You never quite know. A lot of it, what drives demand for gold is emerging markets, but also central banks.
Central banks.
And so, because of the central bank component within the gold market, I think negative gold is also similarly to higher oil, in the sense that higher oil prices mean that a lot of these central banks they're having some issues meeting all of their energy needs, and so they're having to liquidate gold to then meet some of their debt. So a lot of these emerging markets, et cetera, also
And support
operate on
their-
oil and
and
support their economy and their currency.
Currency is
So
the
they're
one of the
having then to
biggest-
sell gold. So the fact that gold is going down, usually gold goes up when we have geopolitical events because people are like, oh, scared. But here, gold had already gone up a lot, and because these central banks are now net sellers because of the higher energy prices, I think the more energy goes up, I think the more oil comes down. So it's not that easy. It's not that one-to-one, but I think that is some of the dynamic that's being employed.
Yeah, a lot of
with the gold
countries are coming to the U.S., like the UAE, and saying, hey, give us a
market.
swap line.
We need credit lines.
We need credit lines because our currency is going to come down a lot. And they're selling gold to support their currency. And they're saying, look, we can give you some of our currency, give us dollars, so we can support our currency. And they're ready. The treasury is setting up swap lines, as they're called,
Yep.
to support. These are the Middle Eastern countries. And so we'll see exactly. And these are sort of the little tiny cracks that you see in the system that are appearing.
And we'll see how it evolves. And once again, this is why we do a weekly podcast. This is why we do a weekly YouTube. You don't have to do it daily. Weeklies maybe even too frequent. We could probably do it monthly, get away with it. But with how frequently things are happening, we're still trying to stay very much on top of it. And one of the things within Iran, I think, is within the politics is also how is this going to evolve between the Middle East, U.S., bigger kind of countries like Russia and China, but it's also the little country that kind of sits in the middle, kind of gets lost, but I think is one of the main reasons we're in this situation today is Israel.
Yep.
And how does this whole impact? Right now, everyone's kind of pointing the finger at Iran and
Right.
saying, "Hey, Iran, you shut down the Strait of Hormuz. It's your." But clearly they shut down the Strait. It wasn't shut until we started, bombing them, right? And so they shut it down. And so watching the geopolitical between the Middle East, do they turn on Israel? And then at what point does the U.S. then say, "Hey, are we going to back Israel now? Are we going to maybe back the Middle East?" All of these bigger power dynamics start to play out. Now, I hope none of that comes to fruition, right? Because Israel plays a huge role politically and business-wise. There's a lot of undercurrents there. But these are bigger themes that the more there's pressure in the Middle East, the more there's oil pressure in the Middle East, eventually people have to start taking some sides, right? And you say, hey,
I think
enough's
the
enough.
biggest player that has to take a side is China. And China's sort of stuck in the middle. They're supporting Iran, but they get a lot of their oil from the Middle East, which they're not getting.
Correct.
And they've got a lot of supply. They've got 200 days of strategic petroleum reserves. But sooner or later, you run out of that.
Correct.
And so
And they're going to pivot towards Russia. So Russia, I think, has by far been the biggest beneficiary.
And they're saying, hey, continue this war. We can continue to make more
Yeah.
money selling our oil.
But that's where right now it seems to be. Once I'm just kind of forecasting. I hope this doesn't come to fruition. But this is what I've always said with the situation in Iran. If there's boots on the ground, right, that's a big escalation. Right now, it's just kind of more talking about making it a parking lot, whatever, all the different rhetoric out there, the AI, the AI images, whatever. But I've always said if China or Russia starts to then kind of they have to get more involved, right? It's not just a proxy, but they get more involved. That's when this thing could really start to spiral. And it doesn't seem like we're going towards a de-escalation with oil prices and DBO, which is our next chart, with DBO, oh, we already went DBO.
We
Yeah.
were in DBO right
Yeah,
here.
with oil
Breaking out.
prices breaking out to the upside, it says, this thing isn't headed towards a resolution. The market's starting to price in that things are going to be worse for a long period of time, particularly this DBO chart. So
Yeah, market knows everything, folks. Everybody in the world, oil prices, when they start breaking out above the highs that we made right here, this is the beginning of the Ukraine war, which was about 21. And that's what you mentioned. We hit 21 3-4 weeks ago when the war started. We came right off of it, right down to here, 1850 or so. And you said if we break below here, the war is over.
Yep.
But instead, we broke up to the upside.
Yeah.
This oil is telling us there's something not quite right
Correct.
in this. Hopefully, it'll all settle down, everybody. And
But hope's not a strategy.
But hope is not a good strategy for your money.
Yeah.
That's really what it is. But on the other hand, look at HYG. It continues to go higher.
Yeah, no, so the economy and everything looks fine. Like I said, this is a difficult market because you have a lot of positive things happening, yet you're having some shocks. The overall stock market is rich, and what's going to trigger the market to kind of realize how rich it is, and you get that correction or that repricing, who knows? But that's what I'm saying. You don't even have to go to strictly even bonds. So when I talk about bonds, maybe even look at high yield bonds. High yield bonds are a function of, yes, they have more credit risk, but you're going to get some nice juicy yields. I was looking at just high yield bonds that go out 2 or 3 years. You're getting 7%. 7% yield, right? And then if interest rates come down for the right reasons, and it's not a big big recessionary type of environment, we're just seeing that valuation come down. High yield bonds, they are risky because the credit spreads are tight, but they're going to hold up better than stocks. I can tell you that much on the
Right.
downside.
Yeah.
And so that's why if you have a bunch of stocks, you can put some of these high yield bonds in your retirement accounts. You don't have to pay any interest or any interest on that 7%. You're earning 7%.
taxes on it.
No taxes. No taxes on the interest. You're getting 7% interest, and you're moving the ball forward when you've already the ball's been moving forward at a really aggressive rate. So it's all about continuing to compound the returns. Don't get greedy. And like I said, these are some of the things we're looking at really closely. It's just we're not getting the triggers yet, but it seems like we have the ingredients. And so when we have to watch it, I think, really closely here over the next couple of weeks and see what happens.
Folks, if you want to check your portfolio, if you want to check yourself right now where you are financially, send us an email. Do it now. Send it to invest@compact.com. We'll get in touch with you, or call us at 800-388-9700. When the market goes down to 20%, if it does, I don't know if it will.
Hopefully you're buying it.
Hopefully you'll be buying it and you've got the right ingredient. Hopefully you're not sitting there saying, oh my God, I'll never do this again, and praying that it comes back. It will, but for the next 3, 4, 5, it could take a long time. Why do that to yourself? So give us a call, 800-388-9700, and we will be more than happy to give you a free checkup on your portfolio. There's no cost, there's no obligation, but you have to do it yourself. We're not going to do it for you. We can't do it for you. You have to take the initiative, and we'll be more than happy to help. Those are our thoughts, those are our observations for this week. We will be back with you next week. Until then,
Good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.